Welcome to TCS, the TechCentral Show, previously known as TC Daily. We've changed our name, but we haven't changed our web address on YouTube, and you can access that at youtube.com/TechCentral. Hit the subscribe button, hit the bell icon, and you'll never miss another episode from TechCentral. Now, I'm joined remotely from Cape Town today by Brandon Doyle. He's the long-serving CEO of Convergence Partners, a private equity business focused on technology infrastructure investment in Africa. Brandon, it's been a while. How are you doing?
Yeah, Duncan, thank you. Very good. And good day to you, and hello to all your listeners and viewers. And no, it's been a great time for Convergence Partners the last few years, and we've had some great successes. So, despite the challenges of having to work our way through various stages of lockdown and various other challenges across the markets that we're in, we've emerged very, very strongly. So I'm pleased.
Excellent. Well, Brandon, I remember coming to see you and your chairman, Andile Ngcaba, when Convergence Partners first got started. And I was trying to remember when that was. I think it was at your offices in Ilovo. Are you still in those offices?
No, we've moved to Rosebank. And in fact, we're very much a new digital firm now. So we have people spread across multiple jurisdictions. The core of our team is in Johannesburg and Rosebank. A couple of us in Cape Town. We actually have a person in Paris who is responsible for all of our investor relations and interfaces with our investment community. We've got an office in Lagos with a couple of people there. We soon will have offices in Nairobi with a couple of people there. So it's very much a footprinted firm across the geography that we're in, and using these digital tools nowadays to keep the team together and keep communications up.
Okay.
So that would have been, Duncan, that would have been early 2000s. We got going in 2003 originally, is when we all came together, and then launched our first investment vehicle in 2006. So it was probably around about then when we first met up with you.
Okay, so the business is 20 years old this year.
That's correct. Yep, yeah. That's right. So we will be celebrating that fact, of course.
Yes.
And in normal Convergence style, it won't just be a party. It'll be some other form of get together that adds a bit of value to the investee companies that we're invested in and our team.
So you and Andile have been in business then together for a considerable period of time now. How did you first meet him? How did this business get off the ground originally?
Yeah, so I was the head of investment banking at Nedbank, and Andile was introduced to me when he was stepping down as the former DG of communications. He had served 9 years in that role and was really kicking around looking for other things to do, and had some ideas as to where the opportunities to invest in would be in terms of the future world that he was seeing at the time, and needed advisors and bankers and providers of capital to help him on that journey. So it started off with Nedbank really operating as his advisor capital provider, and then it got to a point where the extreme ends of what we were doing as a bank for Andile didn't really hang all that well together as a banking organization. And with Nedbank's permission, and it was a very mature process at the time, Andile had a long and interesting chat to Tom Boardman, who was the then CEO, and Brian Kennedy, who was my boss at Nedbank Capital. And what we agreed is that we'd split Convergence Partners out of Nedbank with its assets. And Nedbank were, in fact, our first providers of capital. And that's a relationship that's continued to this day as a very strong banking relationship with the Nedbank group. Yeah, no, and then we decided at that time really was with the capital we'd raised, what opportunities we were going to pursue in the market, and that really launched Convergence Partners as an investment vehicle at the time.
Right. Okay. And has it always had a focus on the sort of private equity space, or have you made venture capital type investments as well?
Yeah, so we have done some earlier stage stuff, Duncan. I mean, I guess just to shape that answer, so our focus really has been a couple of areas. So firstly, geographically, our investment focus is sub-Saharan Africa. Mm-hmm. We started off very South Africa-centric, I guess, in the targets that we were pursuing. as a small investment company with a handful of people and quite modest sums of capital that would only stretch so far, we were really looking for targets that we could assist in their growth across the continent. But sub-Saharan Africa has been our geography. ICT investing has really been our core focus, well, in fact, our only focus. Mm-hmm. And then within ICT, we've gradually developed a core competency and a core investment thesis around the infrastructure layer of telecoms. And that's really where we spent most of our energies and efforts, not exclusively, but that's broadly where our focus has been.
So let's talk a little bit about
and to answer your question, so private equity is really what we do. So we're more looking for mature stage businesses that are already profitable, solid management teams, growing, cash positive, but we are growth capital providers. So as opposed to many funds that are buyout funds, we're growth capital providers. So we inject monies into businesses to help them meet their strategic ambitions. And then we have, particularly in telecom infrastructure, moved quite early stage into the project development stage. So there's a number of investments we hold or have held historically where we, in fact, provided the risk capital to develop those initiatives at project development stage and help founders to get those opportunities to bankable feasibility stage and the like. And then we also have done a few earlier stage venture type investments. Particularly in our first balance sheet, we did quite a bit of that. And then I think we got to a point where we really felt that we had the disciplines more of project equity and private equity than we did of venture capital. It requires different skill sets, different engagement models with founders. But we really wanted to be remained involved in venture capital. So what we did, we actually parceled up our venture portfolio and reversed that into a VC fund based in Cape Town, 40R Capital, and ended up being an investor in their fund. And subsequent to that, we've done investments into other venture capital funds from time to time, just to remain abreast of what's happening in the venture world, hopefully to contribute back into that community, and then find businesses that mature out of those portfolios that are more ready for private equity style capital, and then put money to work into those investments. And that's worked quite well, I believe, for both us as well as these VC funds that we've been backing.
Yes. I remember the deal you did with 40i Capital. I think I came through, in fact, to your Ilova offices at the time to speak to both you and to Justin Stanford of 40i Capital, and
that's right, yeah,
and unpack some of that. But talk to me a bit about some of the deals that you've done to date. You've invested in 35 businesses approximately since your founding. What are some of the more successful investments that you've made in that time?
Yeah, and I guess answering that question depends on how you measure success. As a firm, we really look at it across two very key metrics, and both are important to us and to our investors. The one is financial returns, obviously, and delivering solid financial returns at risk levels that are appropriate for us as an investor and for our backers, and then also generating strong development impact. And really, and that's something that we don't just pay lip service to. We've in fact developed our own bespoke development impact measurement tools, mapping back to the Sustainable Development Goals of the United Nations on an auditable framework. And it's something we now ingrained into the philosophy and measurement of the firm, both the way we report as well as the way we reward our own team. So it's something we take very seriously. And across that spectrum, then, obviously the Nirvana are businesses that generate both strong financial returns as well as good development impact. And when you're building out greenfields, broadband infrastructure of the nature of what we've been doing, it's been a very good journey from a financial returns point of view. These sorts of assets have proved to be very resilient during difficult times, and that's across resiliency, whether it's across COVID lockdowns and the impact that had. In fact, we were a net beneficiary of that, as more of these digital tools like we're using today have become much more prevalent. The bandwidth and data requirements of these tools has just exploded. So the need for all this digital infrastructure just keeps growing, and we are always amazed by how much more the uptake there ends up being on these networks that we build out than we originally project. So it's been a good place to be. So financial returns have been solid, but because you're building out greenfields or brownfields networks, the development impact is also sound. I mean, the model we prefer is wholesale open access, and we think that's the model that not only has the best return outcomes, but also has the best impact outcomes, in the sense that you're really building one network for many suppliers of end services, rather than kind of single networks for a single market-facing participant, as was the case before we launched Convergence. So, but some of the initiatives that we've been involved in, and this really goes back to the early days of Convergence. If I look at our first fund, as it were, which is more a permanent capital vehicle, we were early investors into things like CCOM, and CCOM was the first subsea fiber network serving the East Africa seaboard. There was just no fiber in that region at all. It was a satellite-only market. And satellite has its use, but its use for sure is not to provide backbone internet infrastructure. It's just too expensive and carries traffic. That's way too thin for that. We've launched satellites ourselves, so we still see use case for satellite, but it's really point to multi-point, particularly in markets where distribution, either of a broadcast signal or gathering of data from, let's say, a mobile network that is spread across the country, such as the DRC. That really does have its place. But East Africa was using satellite for, as I say, backbone. So you're getting crazy outcomes. Kenya was getting internet at like $10,000 a meg, and these sorts of things. So when we launched CCOM, and it was an interesting time for us because when we launched CCOM, it was us and a few other like-minded investors, and the telco operators at the time, all expressed a similar view, which is, really, are you guys going to be able to do this, and you're going to compete with us, or you're going to assist us? There was a lot of skepticism about whether we could pull this off, and on both those measures, financial returns as well as impact, CCOM has been a terrific journey. We in fact still invested in CCOM, as are many of the original founding investors. I think it talks to the quality of the asset and what the investor group thinks of it. And of course, CCOM has developed over time into something quite different to what we originally launched. So that is an example of a good story for us. Another more recent interesting success has been our joint venture with Google, IFC, and Mitsui. So Google had done some fiber deployments in Uganda and Ghana under the banner of a project initiative of theirs called Google Link, and it was really an attempt by Google to get more eyeballs on screens to push their own key core agenda, which obviously their core product sets just require more people to be online, and pick two difficult markets, and in the case of Uganda, a landlocked market, to see whether you can find a business model for building out high quality metropolitan fiber and access fiber. And they'd been doing that for some years, and then realized that maybe they needed some other capital and some friends at the table. And we were invited in together with IFC and Mitsui to assist them with that. And that's been an interesting journey since then, because not only has it been about expanding the reach of those networks in both Ghana and Uganda, and we're by far and away now the largest independent fiber operator in those two markets under what is now called C squared. We've also been able to find business models to successfully go into more difficult frontier-style markets. So markets like Liberia, Togo, more recently the DRC, and found ways to finance initiatives into those markets and generate a successful equity return at acceptable risks, and built a management team that's able to go into markets like that and build greenfields infrastructure. So So that's a more recent and very successful journey. Obviously, we're part way through that journey as opposed to at the end of that journey. Then also in the fiber environment, we were relatively early stage investors in Vumatel, and Vumatel then obviously folded into the CIV8 Dark Fiber Africa, and then we exited that at the time of the announcement of the Vodacom interest there, and that so that's an end-to-end journey for us that was a good financial outcome and also an amazing development impact outcome. Outside of fiber, some interesting things we've done. We've been backing different wireless technologies for a long time. We have a business in our portfolio called Comsol, which is a South African business. And Comsol, at an early stage, we pivoted that business away from being a provider of microwave links to third-party telcos as a project service into a network-owning business, and acquired our own spectrum. And at the time we acquired the spectrum, once again, it was, I don't think it was a deep understanding of why we thought the spectrum that was being acquired made sense. So this was these millimeter band spectrum allocations. So we're talking kind of 28 gigahertz spectrum, which at the time, there was very few global deployments in that sort of spectrum band, but it's dedicated ITU spectrum for telecoms use, and really moves you away from the high interference spectrum in say Wi-Fi and the like, but also it doesn't sit in those GSM family of spectrum, which you can't really compete in terms of the mobile operators, what they're willing to pay for that spectrum on these auctions and the like. So it was, and we were tracking some technology uses of millimeter band globally, and what we were finding is that you were able to get really interesting data throughputs, and obviously because of the way in which spectrum in millimeter band works, you're getting much more bandwidth for the same quantity of spectrum. Sure. Of course, it's just the science behind it. But what was pleasing is that you didn't need to have these microcells. 28 gigahertz spectrum works on a basis that you can actually get quite decent coverage and still get very good data power at the edge of those cells, which is quite unique. And so we acquired the largest allocation of that spectrum in South Africa, and subsequently have been building up this national network, which is really a gap filler for fiber. To go where fiber is a sub-economic in terms of the cost of building fiber for the size of the economy you're reaching, or the end user capacity to spend. And I think we must, but it's gone beyond that.
I think we must get the Comsol guys on the show, actually, because I haven't spoken to them in a while, and they are doing some very interesting stuff. So I think let me look at doing that. But I was interested in what you're saying about CCOM. I mean, you've been invested in there for a considerable period of time. Some of these other businesses that Convergence Partners has invested in has also been fairly long-term. I think Comsol has also been quite a long-term investment for Convergence Partners. Your typical private equity firm, typically, correct me if I'm wrong, looks to invest and exit after maybe 5 years or so. You seem to be taking more of a long-term approach to the investments that you're making. Are you bucking the sort of trend in private equity by doing that?
To some degree, Duncan. So, I mean, as I said, our first capital vehicle was a permanent capital vehicle, so it's unconstrained as to timing of exit.
Okay.
Our second fund, and now this new third fund we just launched, are longer-term funds. In fact, the current fund we just launched is a 12-year fund, which it does go beyond what your normal, typical 7 to 10-year private equity fund life is. And the simple reason for that is because our core investments are into green and brownfields, telecoms infra. Those are longer-term initiatives by their very nature. And our investors agree with that. So the cycle of finding an opportunity, building that opportunity into something that is investable, then building the process and management capabilities around that and maturing the business to a point that it becomes exitable, is a much longer end-to-end cycle than just a classic private equity investment into a mature business that you hold and grow for 3, 4, 5 years and then look for an exit. We do that, of course, as well. So there are a number of businesses that haven't been as long-term hold as the ones you call out. Some that we've held for as short as 2 to 3 years, where we've really put our growth capital in those businesses, scaled very quickly, and then suitors have come knocking. So it is a mixed bag for us. And more increasingly now, we are trying to balance our portfolios that we get a good spread of holding more classic private equity style investments for a more normalized window and these longer term infrastructure type holds.
Okay. Great. So let's talk about the latest news then out of Convergence Partners. You announced on the 30th of January that you have closed your new infrastructure fund valued at a considerable $296 million US. That in soft currency today anyway converts to 5.2 billion rand. I think it's gone up by 100 million since you announced the deal, actually. Tell me a bit about this new fund. It's been open for some time. I think you first opened it in 2020. Who are some of the big names who have invested in this round, and what do you intend to use this particular fund to invest in?
Yeah, sure, Duncan. So we did launch in 2020 the actual capital raise process. Our first close, though, was in July of 2021. When we actually were then open for business with if you like, a minimum viable amount of capital. And then subsequently, there's been a number of interim closes, and what you're talking about, that's just been announced, has been the final close announcement. So we have been open for business and actively making and seeking investments. From a capital raise point of view, it was a very interesting process, because having launched when we did, I think our expectation was that we would find traction with our existing institutional backers, because hopefully we've proven to them the quality of our offering. What has been very pleasing is that we found traction with a number of new logos in this fund. So if you look from Fund 2, if memory serves, we had 7 or 8 investors in Fund 2. We're now sitting at 13 or 14 investors in Fund 3. So there's a number of new faces at the table, and some of those new logos were in fact in the first close. So and that's always quite strong market validation of what you're doing. Yeah, Duncan. So we've got these two buckets of investors that we talk to, and that have backed us. The first and the primary amount of capital has come from the global development finance community, and that's out of the US as well as out of Europe. So the likes of the DFC out of Washington, formerly OPIC, IFC, the investment arm of the World Bank, in turning to Europe, the European Investment Bank, and then many of the European state-owned development banks. So whether BRI out of the UK, formerly CDC, FMO out of Holland, Proparco out of France, the Swiss Development Bank, Bio out of Belgium, FinFund, DEG out of Germany. So, they are all backers of ours. And then the second bucket is really more commercial monies, pension fund and other monies. And there we have KenGen, which is the pension fund associated with the electric utility in Kenya. We've got the Mine Workers Pension Fund here in South Africa, the PRC. And of course ourselves, we also put money into our own funds as Convergence and the team. So that's really the spread of our investors. The theme of investing for us is, so we have gone from just under $200 million fund for Fund 2 to, as you say, just under $300 million for Fund 3. Very much the same. We've changed the name a bit from a communications infrastructure fund to a digital infrastructure fund. And that talks a little bit about where we see the market opportunity changing, and where our emphasis will be. And it almost maps, our 3 funds map the key utilization of networks, the themes that we've seen over these 3 cycles. So when we first put Convergence together, it was very much a voice network that had been deployed by the mobile operators and some of the former state-owned telecom incumbents in the various markets. But that was purposed for voice, and it wasn't a great carrier for data. So how do we build out data networks with what we saw coming downstream at us, which is much more data demand. Fund 2 then was much more about how do you move that now into the conversation around broadband. How do you get proper broadband capacity into the hands of as many people as possible because of the use case of that broadband data in sub-Saharan Africa. So it's not just about Netflix and YouTube and the like. It's also about some services that can be delivered digitally that close some of these service gaps that exist. So whether that's in financial services or education, healthcare, and the like, there was this need to ramp up capacities that go into people's hands, and you're starting to see smartphones getting rolled out and using much more data at the individual level. So that was really Fund 2. Fund 3, really what we're about now is this new cloud and AI environment. And it really is a step change. I think people are underestimating the extent and pace at which things are changing as a consequence of these new technologies that are coming to play. So for us, the change up is not so much we're now no longer going to invest in telecoms infrastructure. It's really telecoms infrastructure that is fit for purpose for this new evolving world. So we're going to ramp up more of our investing in data centers, but not just classic data centers. Also, what do these new edge networks look like? How are we going to deliver quick response time data at the edge of networks using miniaturization of equipment and the like as the means to deploy? So edge networks, what do the sensor networks look like and the video networks look like to enable real-time artificial intelligence to be delivered to customers? So for us, we're really, the way we're looking at this is say, where are the management teams that understand this evolution? Because not everybody does. What are the business models that are going to emerge out of this evolution? And what are the network architectures that are going to support this evolution? And it's, as I say, it's a very, very profound change. On the face of it, it might look like just a lick of paint, but it's absolutely not. And if you look at there's just so many things that are changing at once, whether it's technology with 5G. I think a lot of people are underestimating the power of these 5G technologies and what it's actually going to deliver, and what, and how the mobile operators are going to interface with the market and the new business models that this is going to enable and create. As I say, public cloud and the emergence of what Amazon and Google and Ali Cloud and the like are building, and Microsoft are building as solution stacks on top of their cloud. People still in their minds think of cloud as it's a way of migrating your kind of storage into the cloud, and maybe you can do some data manipulation or having a single view into your data. Where this is evolving to is going to be much more sophisticated than that. And for the African environment, it's a massively positive step, because it's going to commoditize the whole AI stack, and it's going to commoditize a lot of compute and applications to the point of much greater affordability. And these things then become relevant price points to deal and tackle with some of these social gaps I've spoken about. So a lot of what we're doing is moving in that direction. The other is then looking beyond infrastructure. So we've always invested beyond infrastructure, but we're quite mindful of what we do, and where are these adjacencies that we can invest in that really make sense to us, given the nature of the investor we are, and given the skills we have as a business. So fintech for some time has been a big theme for us, but fintech has always been more this kind of growth capital private equity model that I've spoken about before, which is where do we find businesses that are helping with the digital transformation in financial services that are already existing businesses. They're not competing with the banks. They're not competing with the mobile operators. They're supporting that transformation journey. And how do we provide capital into them to assist them with that? Now we're starting to see some emerging new trends that really cross over the infrastructure world and the fintech world, or cross over the telecoms world and the fintech world. So, in Fund 2, we invested in a business called Channelvas, which is now called Optasia, and they are services provided to the mobile operators, scraping data from the mobile operators, returning it as a credit score, for those mobile operators to offer airtime credit with very low defaults and the like. So it's again a high impact business because it's not price gouging the market, very low defaults, so it's not over leveraging the bottom of the pyramid subscribers. So that's been another great story for us. But those sorts of businesses are the businesses we like because I think there will be winners in some of the other fintech players, the neobanks, and some of these new emerging crypto and blockchain fueled businesses. For sure, there will be winners in that space. But picking those winners who are then competing for spend and capital against the majors like the banks and telecom operators, we think that's a tough thing for us as an investor. Maybe there are other investors that are wired differently that can do that, but we're still looking for those new emerging mature fintech players that are proving up their business models and that are sitting adjacent to the major players and basically building a business off of other people's customer base rather than trying to build your own customer base from scratch. That's what interests us in this space. And then what we're seeing there is now the emergence of new credit businesses. And that's where we think this fintech market needs to evolve to, is that, just simply offering new digital payments, or being a neobank to the underbanked. It's difficult, I think, to find a business model there that is going to ultimately make a good return on that capital. I think you do have to evolve into being a credit provider and make better use of third-party capital that is not equity. And we started to see some very interesting plays in that space.
Okay. And your investments for Fund 3, do you see them mainly being channeled into South Africa, or are you seeing some interesting opportunities emerging in other markets on the continent? Where do you see the money from Fund 3 flowing to?
Yeah, so we see it being spread very broadly across the continent, sub-Saharan continent. We do not invest in North Africa. We will go into North Africa through an existing regional play, but we wouldn't invest directly there. So we will spread it around. I mean, and obviously the expectation of our investors is that we end up with a balanced portfolio from a geographic point of view. And we proved that we were able to do that in our first and second fund. So there's no, we've got investments in Mozambique and Malawi and, as I said earlier, Togo and Liberia. And so we were able to find interesting opportunities that return good investments, even in the smaller markets, even in markets where, I think the capital gravitates towards big centers of GDP. So Nigeria, Kenya, South Africa, Egypt really attracts most of the PE and VC money. And we will put money to work in those markets, of course, but not exclusively. We will spread the capital around. And the opportunities that come out, the benefit of having been involved in telecoms investing, Duncan, for as long as we have, is that markets don't evolve and mature at the same pace. So really the business models and the technology models that worked in a more mature market you can then start thinking about bringing that style of thinking with localization, because we see a lot of guys who think you could just forklift a business model from, say, South Africa or Nigeria into an adjacent market. You have to be very, very conscious of the local dynamics, whether that's regulatory or the way in which people on the ground consume bandwidth, affordability issues. How do you deploy the network in terms of environmental issues? So there are things you of course have to think about, but you can, as a private equity investor, start thinking about other markets as markets mature and infrastructure becomes more commoditized and therefore doesn't really generate a private equity return. It's more a utility style return. There are other markets that you can still generate those outsized early stage investment returns. So that's how we think about it. But one thing I will say is that the pace of change, though, it's great to say that and map that out, but the pace of change is accelerating. You've probably been following the story of this chat GPT. I mean, if you look at how quickly... 2.0. I mean, it's just insane. I mean, it built 100 million global subscribers in 2 months. And if you just map that back to other apps or other solutions that have emerged in the last 10 years. Yeah, like TikTok, I think took 9 months to get to that number. I think Instagram took like 2.5 years, and Facebook and Twitter took longer. And so it's not only that these new applications are finding an audience that much quicker, is that each iteration of these new developments finds it sort of builds on what's happened before it, and you've got this accelerating machine that's going on, and keeping pace with all that is critical. So.
Now tell me, the Fund 1 and 2, the capital that you raised for those two funds, is that now fully deployed?
Yes. Yeah. So Fund 1, because it's permanent capital, there's flexibility of capital there. So we can raise, and we do still raise, some capital into the vehicle itself and or its portfolio companies. So we, within boundaries, of course, we're conscious of our status as fund managers to other private equity funds and what we promise our investors in those funds. But within defined parameters, we are able to continue to invest there and continue to raise capital there. Fund 2 and we do that in a very modest scale at the moment. Fund 2 is fully deployed. And it's really been about growing those businesses and building them to exit. We have had a number of exits. We should be announcing another 2 exits on that fund in the next very short while. Again, some very positive outcomes for us. And then Fund 3, we're very much at the early deployment stage.
Right.
We've announced one investment to date. And I think we may have announced our second investment, or I might be front running the announcement, but we have made an investment so we invested in a business in South Africa called C-Track. Was our first investment, which was, on the face of it, looks like a vehicle tracking business, but it's much more than that. You might remember, Duncan, there was a business called Digicore that was listed on the JSE many years ago. And this is the evolution of Digicore. So it's a business that understands that heavy fleet industry deeply, and then tracks data on devices that are embedded into these vehicles in the field, and returns that data back to these fleet owners with very meaningful inputs for them to operate and risk manage their business and get operational efficiency. So whether it's driver behavior, safety and security, vehicle maintenance, fuel management, trip management, there's a lot of, it's basically a big mobile IoT data engine for us. And that's why we invested there. And then more recently, we've invested in this business called Merit, which is currently based in Nigeria. And that's a wireless wholesaler. And they've basically been deploying networks using technologies where they can reach the underserved communities, even in an urban environment, with high broadband capacities. And then they offer that to the mobile operator. So they don't directly face, it's not a B2C, it's a B2B wholesaler. And they offer that to the mobile operators as a way to extend their network reach on a shared infrastructure basis into communities that are otherwise quite difficult for them to find an economic case for. So again, that's another example of something that ticks the development impact bucket for us quite strongly.
Before I let you go, I just want to talk a bit about the investing landscape in 2023. We've seen the US stock market coming under some pressure with the tightening interest rates environment. It seems the US Fed is going to continue tightening. What is this global context, this global environment mean for investment in technology companies in Africa? Are you seeing, there's been a lot of money flowing into venture capital across the continent, but do you think that perhaps with risk appetite declining somewhat in this tightening interest rate environment, that global investors are looking perhaps to slightly less risky investment opportunities, perhaps through the private equity type route?
Yep, definitely, Duncan. So, in a way, we've been purposefully slow in deploying capital out of the new fund because we have been worried about the price reset that we thought was inevitable off the back of everything, including in technology. And that has happened to some degree. There are pockets where we think it could still come off a bit more. But we're now finally seeing in the African context, bringers of opportunities to us have now got more realistic valuations in mind. So that's why we now feel much more comfortable in more aggressively investing. And 100% to your point is that, I think there was a lot of investment appetite and a lot of capital raised for this geography, which we see a lot of kind of risk-off behavior now started to come to the fore. The opportunity we see is that there's a lot of quality businesses out there that have been well capitalized, but still need additional rounds of capital to really get to where they need to. And the role we see ourselves playing is finding those businesses that then get to a point where there's a lack of support from the capital sources they had before because of this risk-off issue, and really find quality businesses that we can then continue to support. And that's very much these businesses that are in that VC to PE transition, that are maturing but now running out of road from a capital point of view. So we think it creates great opportunity, and hopefully we can play a role to help those founders and those existing shareholders to find a pocket of capital to continue growing those businesses out.
Great. And lastly, how long do you think it's going to be before you have fully committed the capital in Fund 3 and you're out in the market looking to raise funds for Fund 4?
Yeah, so we've got a 5-year window to deploy the capital. Obviously, we've already eaten into some of that because we had the first close in 2021. So that's the normal window. We'd hope to deploy the capital before then. So within the next 2 to 3 years, be done. And then obviously turn to the market for a fourth fund. At the same time, we're mindful of some of the, up till now, telecoms has been a fairly benign negative impactor, particularly talking about climate change in terms of as a consumer of power and energy. As we move into this high intensity bandwidth world and more data centers get built out, that equation starts changing, and telecoms becomes a much more power hungry utility. So we're in the early stages now of launching a parallel themed fund. So we're coming to market now with what we call a sustainable energy fund. So we're not really waiting for Fund 3 to be fully deployed because this is a different theme. We have already started choosing a team to run that fund for us. But partly it's as an offset for some of the negative impacts that telecoms might now be doing, and partly because we think as more and more green generation capacity comes on stream, there's a need for building out the technology layers that sit between generation and consumption, whether that's smart grids or energy exchange type platforms, and the key enablers in the ecosystem that are going to fuel this the whole new emerging energy economy. So we'll soon be in market raising that fund.
Fantastic. Lots of stuff on the go, Brandon. Very good to catch up with you after so many years. Brandon Doyle is CEO of Convergence Partners. Look forward to having you on the show again at some point to talk about some of these investments that you're planning.
A pleasure, Duncan. Thank you very much.